Gold is at $4,520. Tehran just publicly denied any peace talks are happening. Washington says they are productive. One of those statements is a lie. And the gold market is pricing in neither outcome cleanly right now. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, gold has stalled at a critical level heading into a Friday close with a live geopolitical binary still unresolved. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now, subscribe to OG John AG 1.0, and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. Gold and the US-Iran diplomatic contradiction. Gold is trading in the $4,520 to $4,565 range on March 26, 2026. The US dollar index sits at 99.66. The 10-year Treasury yield is at 4.35 to 4.39%. President Trump referenced a 15-point peace framework in direct talks with Iran. Tehran's foreign ministry publicly denied any negotiations are taking place. Those two statements cannot both be true. The timing is what deserves scrutiny, not the event itself. The timing. Gold staged a partial recovery this week after collapsing from its January 29th record of $5,594.82. That recovery is now stalling, directly into a Friday close, with zero diplomatic resolution confirmed. Think about what that sequence actually means. A market that cannot price a binary outcome does not move cleanly in either direction. It consolidates, it waits, and then, when the binary resolves, it moves fast. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. Shanghai gold is pricing above $4,600 per ounce in USD equivalent terms right now. COMEX spot is at $4,520. That is an $80 premium. The last time Shanghai sustained a persistent premium of this magnitude over COMEX, gold did not come down to meet Shanghai. Shanghai held, and COMEX caught up. The data is doing the talking. Let's build it out. Now let's build the full picture because this diplomatic contradiction does not exist in a vacuum. The US dollar index report from ICE shows DXY at 99.66, near the critical 100 threshold. Every single time DXY has approached 100 in the past 3 years, it has acted as a ceiling on dollar-denominated gold. That is not coincidence. That is a pattern. The U.S. Treasury yield curve, published daily by the Federal Reserve, shows the 10-year at 4.35 to 4.39%, near 8-month highs. That number matters because it represents the opportunity cost of holding gold. At 4.39%, real money earns a return sitting in bonds. Gold earns zero. JP Morgan maintains a year-end gold target of $6,300. Deutsche Bank holds $6,000. UBS holds $6,200. Those institutions have not moved those targets, not $1. Meanwhile, leveraged funds and commodity trading advisors have been net sellers since January, executing standard risk reduction after a parabolic move. The institutional longs are structural, the sellers are tactical. That gap does not last forever. And here is what makes that picture even harder to ignore. Shanghai gold at 4,600 plus USD equivalent versus COMEX at $4,520 is an $80 structural premium. That premium is being paid by physical buyers, central banks, sovereign wealth funds, and institutional allocators in Asia who cannot substitute a paper contract for allocated metal. At the same time, Western paper markets are selling. Leveraged funds net short, CTAs reducing exposure. The structural picture is a physical market buying above paper prices while the paper market sells. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups can take a long time to resolve. The $80 Shanghai premium has existed for weeks. It has not triggered an immediate COMEX repricing yet. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the macro variable, because the US-Iran conflict is no longer a backdrop. It is the primary variable. Here is the number most people are not talking about. Approximately 20% of global oil supply transits through the Strait of Hormuz. If that flow is disrupted, energy reprices. Energy reprices, headline CPI spikes. CPI spikes, the Federal Reserve cannot cut. Fed cannot cut. Real yields stay elevated. Real yields stay elevated. Gold faces sustained headwinds on the paper market. That is the full chain. Tehran's public denial of peace talks on March 26th is not a minor diplomatic formality. It is a signal that the conflict premium in oil, and therefore in inflation expectations, is not going away this week. Markets are currently pricing a partial de-escalation. Look at gold at 4,520, down from 5,594, and tell me what probability you are putting on a full ceasefire before Monday's open. When markets start pricing the reality of what Tehran is actually saying, gold reprices upward as a safe haven, oil reprices upward on supply risk, bonds reprice downward as inflation expectations rise. That is the historical pattern. Every time a major Middle East conflict has been publicly denied by one party while confirmed by another, the market eventually priced the more hawkish outcome. It has not been different yet. Gold Western spot at $4,520 to $4,565. Shanghai gold equivalent above $4,600, an $80 premium on the physical side. The short-term picture is this. Gold is consolidating at a level that cannot hold indefinitely with a live binary overhead. If the Friday New York close holds above $4,500 with no negative diplomatic headline, there is a base building case for a Monday open above $4,600. If Friday closes below $4,250, with Tehran maintaining its denial, the gap risk to the downside is $4,100 to $4,200 on Monday's Asian Open. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does on Monday morning. Nobody can. If you think you know, good for you. This is a market with a live geopolitical binary, a DXY at 99.66, and a Fed that has explicitly ruled out cuts in 2026 under Chair Kevin Warsh. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case. And the one you ignore is the one that will cost you, so let's run both. The bear case is real. 1. DXY at 99.66 is a historically consistent ceiling on dollar-denominated gold. 2. 10-year Treasury yields at 4.39% make the opportunity cost of gold the highest it has been in 8 months. 3. Federal Reserve Chair. Warsh has explicitly held rates at 3.5 to 3.75%, with no pivot signal for 2026. The bull case is equally real. 1. Shanghai gold is pricing $80 above COMEX right now. Physical buyers are paying more than the paper market says gold is worth. 2. JP Morgan, Deutsche Bank, and UBS all hold year-end targets between $6,000 and $6,300. None have revised downward post-correction. 3. Tehran's denial of peace talks keeps the geopolitical premium alive and the ceasefire trade unpriced. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing: a market under structural tension, with physical buyers paying above paper prices in Shanghai, institutional targets unmoved at $6,000 plus dollars, and a geopolitical binary that resolves only one of two ways. The structural pressure is already built. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check the data yourself. ICE Data Services for the DXY. U.S. Federal Reserve H15 release for Treasury yields. Shanghai Gold Exchange for SGE spot pricing. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.